Let's talk about making your money work for you. Investing is the key to financial freedom, but the choices can feel overwhelming. For most beginners, it comes down to a simple decision: index funds or individual stocks. This choice shapes your entire investment journey. We'll break down what each option means, their pros and cons, and help you figure out which path fits your goals. What's an index fund? If you've ever wondered how to invest without constantly stressing over which stocks to pick, this is your answer. Index funds are one of the simplest, most reliable ways to grow your money over time, even if you're not a financial expert. Think of it as a basket holding tiny pieces of hundreds of companies, like buying the whole supermarket instead of picking just one item off the shelf. Instead of betting on a single winner, you get a taste of everything, from tech giants to household brands, all in one go. The S&P 500 Index Fund, for example, gives you a slice of the 500 biggest US companies in one move. That means you're investing in leaders like Apple, Microsoft, and Amazon, plus hundreds more all at once. This is called diversification. If one company tanks, the others help balance it out. Your risk is spread out, so you're not putting all your eggs in one basket. This safety net is what makes index funds so appealing for long-term investors. Index funds are passive, so fees are super low, sometimes just a few dollars a year on a $10,000 investment. That means more of your money stays invested and working for you, instead of being eaten up by management costs. A top example is the Vanguard 500 Index Fund, known as VOO. Buy one share, and you're instantly diversified across hundreds of companies. It's a favorite among both beginners and seasoned investors for its simplicity and reliability. You don't have to track CEOs or earnings reports. Just buy, hold, and let the market work for you. It's truly a set-it-and-forget-it approach, perfect for anyone who wants to invest without the daily hassle. Historically, the S&P 500 has averaged about 10% annual returns. That's simple, effective, and stress-free growth. Over decades, this steady compounding can turn small investments into real wealth, making index funds a smart choice for building your financial future. Now, let's look at individual stocks, the high-stakes game of picking winners. When you buy a stock, you're betting on one company's future. If you pick right, the rewards can be huge, but it's not easy. You need to research financials, understand the business, and keep up with the news. The upside: if you'd bought Amazon in 1997, you'd be a millionaire today. The risk: for every Amazon, there are dozens of blockbusters, companies that disappear, taking your money with them. Picking stocks means concentrated risk. One bad move, and you could lose everything. The potential for big gains comes with the real chance of big losses. Let's break down the classic tug-of-war between risk and reward when it comes to investing. On one side, you have index funds, and on the other, individual stocks. Each path offers its own unique set of opportunities and challenges. Index funds offer instant diversification and low fees, making them a steady, low-stress way to build wealth. By spreading your money across hundreds or even thousands of companies, you reduce the impact of any single company's poor performance. This approach is designed for those who want to grow their money over time without constantly worrying about market swings. The downside: you'll never beat the market, you'll just match it. Your returns will mirror the overall market's performance, for better or worse, so you won't see those dramatic gains some investors chase. With individual stocks, the upside is unlimited. If you pick a winning company at the right time, your investment could multiply many times over, leading to life-changing gains. Pick the right company, and your returns could skyrocket. This is the dream that draws many people to stock picking, the chance to find the next big thing before everyone else does. But the risks are much higher. Stock prices can swing wildly, and even the most promising companies can stumble unexpectedly, causing your investment to drop sharply. One bad stock can wipe out your gains. A single poor decision, or an unforeseen event, can erase years of progress in a matter of days. Index funds require almost no effort. You can set up automatic contributions and let your investments grow quietly in the background, freeing up your time and energy for other pursuits. Stock picking demands time, research, and a strong stomach for volatility. You'll need to stay informed, analyze companies, and be ready to make tough decisions when markets get rough. Most people who try to beat the market with stocks end up underperforming simple index funds. The odds are stacked against consistently picking winners, especially over the long term. Index funds are about steady growth. Stocks are about taking big swings. One offers peace of mind, the other, the thrill of the chase. You also have more control with stocks. Choose companies you believe in or align with your values. This personal touch can make investing feel more meaningful, but it also means you're responsible for the outcome. But with control comes responsibility and risk. Every decision is yours, and every mistake can be costly. Ultimately, it's a trade-off. Safety and simplicity versus potential and risk. The right choice depends on your goals, your risk tolerance, and how much time you want to spend managing your investments. So, which path should you take when it comes to investing? Index funds, individual stocks, or maybe a mix of both? It's a big decision, and it really depends on your personality, your goals, and how much time you want to dedicate to learning about the market. For most people, especially those just starting out, index funds are usually the smartest choice. They're simple to understand, have low fees, and historically deliver solid returns over time. You don't need to be an expert or spend hours researching companies. Just invest and let the market do the work for you. But if you're someone who enjoys digging into financial reports, following the news, and you're comfortable with taking on more risk for the chance of higher rewards, then picking individual stocks could be exciting and potentially more profitable. Here's something a lot of people don't realize. You don't have to choose just one path. You can absolutely combine both strategies in your portfolio. Many successful investors use what's called a core and explore approach. This means putting the majority of your money into index funds for stability, while using a smaller portion to invest in individual stocks you're passionate about or believe have strong potential. This strategy gives you the best of both worlds, the steady growth and safety of index funds, plus the excitement and possible higher returns from picking your own stocks. The key is to be honest with yourself about your financial goals, your comfort with risk, and how much time you're willing to spend managing your investments. There's no one-size-fits-all answer. Remember, there's absolutely no shame in choosing the slow and steady route. Legendary investor Warren Buffett actually recommends index funds for most people, because they work. The most important thing is to take that first step and start investing. Your future self will thank you for it.